Hey, hi everyone. Welcome to another video in our hedge fund series. So today we'll go through different strategies like risk parity strategy, manage future strategies, and also defend and carry strategy. And we'll go through specific examples of these strategies being used and the companies and famous events when these strategies are used. Okay, so first one is risk parity. Risk parity is basically, it allocates risk equally across assets like stocks, bonds, and commodities rather than allocating fixed capital percentages. So the main diversification portfolio, what it does is invest based on the capital, right? So capital percentages, like you invest some 20% into financial services sector, 20% into of the capital into suppose uh, IT industry and so on. For example, so you the typical diversified portfolio involves allocating a certain percentages of capital across sectors or across assets. But this risk parity is a new thing, so it focuses on the risk being allocated, equally. So you basically allocate risk equally across assets like stocks, bonds, and commodities. So that's this strategy, and these risk parity strategies typically uses leverages on less volatile assets like bonds. They use leverage to match the equity risk exposure. Okay. So in equity, you have more risk, and in bonds, you have less risk. So you can take leverage in bonds to match the equity risk exposure. The idea is to allocate risk equally across assets. So who uses this risk parity strategy? Bridgewater's all-weather fund uses this strategy. In its 1996, this all-weather fund was formed. It's pioneered by Ray Dalio. It leverages bonds to balance equity risk. Solid performance was there post 2008 crash for this fund. And AQR Risk Parity Fund also uses this risk parity strategy. AQR's take on equalized risk. AQR uses this risk parity strategy. It allocates risk equally across the asset classes. So yeah, this is basically this risk parity fund is AQR's risk parity strategy being used across asset classes, equalized risk being used across asset classes. Other adapters of this strategy are BlackRock, Pan, Agora, pension funds, endowments, and State Street, SSGA, ETF collaboration with Bridgewater. So the performance of this risk parity strategy is 2008 financial crisis. During that time, risk parity showed resilience, and it outperformed equity heavy portfolios. Yeah, during that time, yeah, equity portfolios got a hit. Even during COVID, also equity portfolios would got a hit. So during such times, risk parity portfolios show resilience and good performance. But 2010 to 2020s, which is a bull run, right? During equity bull run, these funds don't perform well, so they underperformed during strong equity bull runs, and these many funds shrank during that time. Recent ETF launch, so SSGA and Bridgewater's all-weather ETF launched despite current volatility, targeting advisor interest. Pros and cons of this risk parity strategy is balancing the risk across market regimes. So that's the main advantage. Okay, and it's less volatile and stable returns will come through these strategies. Cons are it underperforms in strong bull markets. Leveraged bond exposure increases risks. And correlation shifts can hurt. Yeah. Then we come to the managed future strategies. So managed future strategies is using futures contracts across asset classes for speculation, hedging, and arbitrage. So this includes the future contract strategies, includes trend following strategies, mean reversion strategies, spread trades, and roll strategies. Key tools are cash and carry arbitrage, so buying spot asset and shorting the futures. This is profitable if futures price is greater than spot plus carry cost. Managing future strategies include this trend following, mean reversion, spread, and roll strategies, and cash and carry arbitrage strategies. It's examples where this is used is oil and agricultural futures, frequently used in cash and carry. Macro focused hedge funds and CTS, commodity trading advisors, rely heavily on futures across commodities, bonds, currencies, and equity indices. So yeah, here we are basically using futures contracts, to make money, and you use in the futures contract certain strategies like trend following, mean reversion, and spread and roll and cash and carry arbitrage to make money. And this is heavily used in oil and agricultural futures and the macro focused hedge funds. Yield carry and defend or yield slash carry or defend and carry strategy. This is carry strategies are used. The strategy is basically buy in low interest rate currency, borrow in low interest rate currency or assets, and invest in higher yielding ones. So you'll make money, the difference in the interest rate. So that's what this strategy is. So if you borrow in US, which has a low interest rate, and you invest in India, which has a higher interest rate, that is a sort of a carry strategy. But here the example is yen carry trades in the 2000s, borrowing in yen and investing in higher rate currencies. This got unwound in 2024 when Bank of Japan tightened the monetary policy. Carry trades got unwound and causing volatility. So defend and carry isn't a formal term, but conceptually means combining carry return with the downside protection using hedges or structured options to mitigate losses. So real world cases where these strategies are used is Bridgewater all-weather strategy, risk parity, toggles across asset classes to balance inflation, growth, and deflation scenarios. SSGA plus Bridgewater ETF launched recently to offer risk parity in ETF form. Yeah, yen carry trade trends. So power EM growth in the early 2000s. Okay, and a huge unwind fluctuation in 2024. Cash and carry classic uses in physical commodities like oil, grain to exploit futures premium. Summary is risk parity. The mechanism is strategy. Basically, it's used to equalize the risk across and via leverage across asset classes. Advantages are lower volatility and diversified risk. Underperformance in equity rallies, leverage risk will be there and correlation shifts will be there. Those are the challenges. Futures trading, managed futures trading. Uh, Basically, this uses speculation and hedging via contracts. Advantages are it's highly liquid and diverse assets could be traded upon. Challenges are it requires margin and subject to roll and padding. Carry trade, borrow at low interest and invest in high interest rate assets. Gains from interest rate differential. Vulnerable during rate shifts and forex risk is there. Cash and carry, buy spot short futures and risk free if conditions met. Requires storage and precision timing. Okay. So this is the hedge fund strategies we discussed about. So risk parity futures trading, carry trade, cash and carry. So yeah, and the what are the strategies when they are used? What are the advantages and challenges? Also, we discussed as a part of the summary. Thanks everyone for joining the call. Have a nice day. Bye.